Okie dokie, I think we're going to kick off now. It just hit 4 o'clock. So thank you everyone for joining us for the final session of the Dublin Economics Workshop, the final session of this year's conference. We've had some great presentations and discussions over the past week. And I think one thing that struck me is just the remarkable overlap. One of the common themes that's going to come up is that there are certain groups who have definitely been hit more by the initial shock and by a slower recovery over the past few months. And that's something which I think has come up repeatedly in the labour market session and the housing session. And one group in particular that's come up is those younger adults in their 20s who've been more likely to have lost their jobs, still more likely to be out of work, but also more likely to, I suppose, be in the private rental market, where, as we talked about on Monday, there's still big issues that need to be addressed, been huge policy challenges. But there's also been some great discussion of some of the policy options that are there. We saw on Tuesday, great discussion of the potential and the evidence behind a lot of the policies that could work to address some of these issues, and active labour market policies, and where we need to focus resources and intention there. But today we're going to, for this session and our final session, we're going to turn to a slightly different topic. We're going to turn to the topic of a question which has been asked much in Europe and internationally in the past few years. Is Ireland a tax haven? And so joining us today, we have a great panel of 3 speakers. We have first Gabriel Zucman from the University of California, where he's at Berkeley, where he's Associate Professor of Economics. He is author of lots of articles, which anyone in kind of in those areas of economics will have come across, published in some of the top economics journals. He's also been very much involved in the policy debate in recent months over in the US and for the election there. He's behind lots of some great ventures out there like the World Inequality Lab, and also on the tax tools that he's developed and shown the various possibilities of reform of the policies put forward in the US election. We're also joined by 2 speakers closer to home, Seamus Coffey and Ashling Donohoe. Seamus is a more full overview when he comes in, but he's a lecturer in the University of Cork, University College Cork, a different UC, maybe a little bit less sunny than Berkeley, but closer to here anyway. Then Ashling Donohoe is also joining us. She's a partner at Andersen, Ireland. She's a taxation expert there, and so she's going to be giving us a slightly different take from the economics. The first 2 presentations we'll hear. So we're going to start first with Gabriel. So Gabriel, I've given you kind of a broad overview there, but if you can take it away and tell us about your response to the question of is Ireland a tax haven?
Thank you so much. Thanks for having me. It's a pleasure to be here virtually today. So let me start by sharing my screen. All right. Okay, so can you see this? Great. So I'm going to try my best to address the question in the context of presenting recent research that I've conducted with my co-authors, Thomas Torsloff and Ludwig Wier, that's entitled The Missing Profits of Nations. And what we're trying to do in that research is to address a very basic question, which is the following question. How much profits move across countries today because of differences in corporate income tax rates? So there are 2 ways that multinational companies can move profits across borders. One is by moving capital to low tax places, factories, headquarters, equipment, and so on. The other is by moving paper profits, by shifting profits to subsidiaries in low tax places. So the question that we ask in this research is the following. Imagine that there was a perfect international tax coordination. Imagine that tomorrow all countries agreed to apply the same corporate income tax rate, the same definition of corporate profits, okay, full harmonization. In that world, how would the geography of profit change compared to today's world? In other words, which countries would gain or lose profit, taxable profit, compared to today? And how would that change, where would that change come from? Would it come from a relocation of capital or would it come from a reduction in paper profit shifting? And the way we address these questions, and let me stress at the outset that we are not going to have final, perfect, definitive answers to these very important but complicated questions, we try to make some progress by using new data that's been released in the last 10 years in most countries, which is known as foreign affiliate statistics. So these are data that record the wages, value-added profits made by foreign affiliates of multinational firms in each country. So for instance, in Ireland, we have, there is data now on the value-added, the wages paid by the foreign affiliates, the affiliates of foreign multinationals that operate in Ireland. And we can use this data that now exists in many countries, including some of the key offshore financial centers in the European Union, Luxembourg, Netherlands, and so on. We can use this data to provide a kind of first global map of where multinational companies book their profits today. And using this data, we make a very simple, but I think quite striking computation. That is, we compute the capital share of value added in foreign firms versus local firms in each country. And when we do that, we see a striking pattern emerge. We find that foreign firms, so for instance, affiliates of US multinationals, say in Germany, generally speaking, have a lower capital share, a lower ratio of profits to wages paid than local firms and local German firms in my examples. So firms that are not part, firms that operate in Germany, but that are not part of a foreign multinational group. And there is just one exception, it's a big one, which is that in low tax countries, in tax havens, we see the opposite pattern. We see hugely higher capital shares in foreign firms as opposed to local firms. So you take Ireland, I'm going to show the graph on the next slide. In Ireland, the affiliates of foreign multinationals look vastly more profitable than local Irish companies. Now let me show you the graph, and then I can describe using that graph what's going to be our estimation strategy, which is very simple. So on that graph, we're showing a simple statistic, which is the ratio of pre-tax profits to wages paid. And we're showing that ratio separately for each country for local firms and foreign firms being affiliates of foreign multinationals. So you take Ireland, and in Ireland, for local Irish firms, not part of a foreign multinational, for any euro of wage paid, local Irish firms record about 60, 70 cents in profits. Okay, that's the black bar for Ireland. Now you look at foreign affiliates operating in Ireland, and for any euro of wage paid, these foreign firms record close to 8 euros in profit. So profit to wage ratio of 8. In Puerto Rico, it's even larger than that. So profit to wage ratio of almost 17 for any dollar of wage paid, $17 booked in profit by foreign multinationals, essentially US multinationals that operate in Puerto Rico. Puerto Rico is not part of the US for tax purposes. You see the same pattern in Luxembourg, in Switzerland, in Singapore, in Hong Kong, and so on. And then on the right-hand side of the graph, you see the opposite pattern for high tax countries. That is, in high tax countries, foreign firms look systematically less profitable than local firms. You see that in Australia, in the UK, in Spain, in Japan, in France, Germany, Italy, and so on. And so in that work, getting back to the thought experiment that I was mentioning at the beginning, what would happen if all countries had the same tax rate? Well, something that might happen is that within each country, the pink bar would become close to the black bar. Okay, so we can interpret, and we explain in the paper the conditions under which we can make that inference. We can interpret the excess profitability of foreign firms, as opposed to local firms, the excess of the pink bar over the black bar, as reflecting essentially profit shifting. And so in a world with perfect international tax coordination, there will not be any reason to shift profits across borders, so the pink bar would be close to the black bar. If you equate the pink bar to the black bar, you get our benchmark estimate that about close to 40% of multinational profits are shifted to tax havens each year. Okay, multinational profits, these are the profits made by companies outside of the country where they are headquartered. Think of the profits made by Apple outside of the US, or profits made by BMW outside of Germany. Our estimate, equating the pink bar to the black bar within each country, is that close to 40% of these multinational profits at the global level are shifted to tax havens, with an important role being played by Ireland, as you can see here on that graph. The second step of our work, of our estimation procedure, is then to allocate the shifted profits to the countries where they would be booked absent differences in corporate income tax rates. And to do that, we essentially follow the money in balance of payments statistics. So for a long time, balance of payments data were only aggregate data. So for instance, in 2014, we know that Ireland exported a lot of information and communication technology services, ICT, insurance and finance services, medicaments, blood. Okay, so that's what was known until recently. Now we have bilateral balances of payments, in particular bilateral flows of goods and service exports and imports. So we know the destination of these exports, and by following the destination of the exports of services that have been found in the literature to be most conducive of profit shifting. Think of services like the right to use intellectual property, or management services, or financial services. So by following the destination of these exports, we can allocate the profits that we estimate have been shifted in Ireland to the countries where they would be booked absent differences in corporate income tax rates. The outcome of this research is that we have granular estimates of profit shifting, so estimates of how much profits are shifted out of France, let's say, to Ireland, or Germany to Switzerland. And all of that is available on this website, missingprofits.world, with estimates for each country. Here is the case of Spain. If you click on Spain on this map, you get this table that reports our estimates of how much profits are being shifted out of Spain, to which countries these profits are being shifted. In the case of Spain, that's going to be mostly the Netherlands, number 2, Luxembourg, number 3, Ireland. And to summarize the main results, so as I mentioned, 40% of multinational profits shifted to tax havens. Main winners, in a sense, are the countries like Ireland or Luxembourg or Singapore that attract these profits. They win in a very specific sense, which is that if you are a relatively small country and you manage to attract a huge amount of paper profits, even by taxing these profits at a very low rate of 3, 4, 5, 6%, that's going to generate a lot of tax revenue relative to the size of your economy. And that's what we see in those countries. And the flip side of that is that the large non-haven EU countries lose a substantial amount of tax revenue, as much as 20% of their corporate income tax revenues in places like Germany or France, according to our estimates. Last two results, and then I give some final thoughts. We find that profit shifting, getting back to the questions I asked at the beginning, profit shifting swarms is much more important quantitatively speaking than tax-driven tangible capital mobility. And we also find that this profit shifting affects headline economic indicators such as trade balances, GDP, capital and labor shares of value added, and so we provide corrected estimates for the main countries of these headline economic indicators, taking into account profit shifting. Let me just focus for a second on the case of Ireland using data for 2018, so data that was just released by the Bureau of Economic Analysis in the US in August, and which is this is coming from the outward foreign affiliate statistics of the US. So these are US multinationals that report confidentially to the Bureau of Economic Analysis about the activities of their foreign affiliates. And what they report is that their affiliates in Ireland in 2018 made close to $100 billion in pre-tax profits. And that is more than all the profits booked in all other European countries combined when we exclude the other tax havens of the EU, Netherlands and Luxembourg, primarily. Okay, so that's a very striking picture. That's what the US multinationals say. They say, we booked $100 billion in Ireland. There are other US data, but these are the most recent data. And what's interesting is that these are data for 2018, so the first year after the US tax reform. And it seems, according to these data, that not much actually has changed when you compare 2017 to 2018. So let me conclude by just with this slide by asking, why should we care about all of that? So people in economies, but also people in the public, of course, have different views about the efficiency cost of taxing capital, whether it's a good idea or a bad idea to tax capital. And I have nothing original to say about that question. The only thing that I'm saying is, whatever your view about the efficiency cost of capital taxation, large-scale profit shifting raises serious issues. First, it distorts competition because these are not small and local firms that are shifting profits to Bermuda, to Ireland. These are the very largest multinational companies. In the case of Ireland, essentially US multinational companies. Second, this has implications for inequality. These fees are raised to the bottom with corporate income tax rates, which reduces the taxation of capital, which, everything else equal according to standard economic models, tends to increase the concentration of wealth in the long run. And third, there is the obvious loss of tax revenue for many countries throughout the world, which in the current context of large deficits in the COVID era is particularly problematic. Okay, I'll end there, and I look forward to the discussion. Thank you very much.
Great, thanks very much, Gabriel, for that presentation. So already questions starting to come in on that, and just to remind people that they can submit questions via the Q&A function that they'll see at the bottom of their screens. So yeah, thanks again to Gabriel for his initial presentation, setting out, I suppose, the case on how he sees maybe Ireland contributing to the shifting of profits and the impact that has. Next up, we have Seamus Coffey, a lecturer in the Department of Economics in University College Cork, the less sunny cousin of UC Berkeley. He became a member, many of you will know him from his role as previously a member of the Irish Fiscal Advisory Council, where he was also then the chair from January 2017, and appeared quite often on our airwaves and indeed screens. By no means supporting the government through the vast majority of that, often giving an occasional kick in public. So he is going to be talking today about his view on, is Ireland a tax haven? And Seamus, I'll hand that over to you now.
Thanks very much, Barra, and thanks very much to the organisers for the invitation to speak. Just going to share the screen there and assume that that can be seen. So yes, an interesting session. I guess in terms of the question, I'd imagine that almost everybody on here already has the answer in their head, and what's going to happen over the next hour and a half isn't going to change anyone's view of whether they consider Ireland to be a tax haven or not. The evidence as presented can, in a sense, offer support to whatever view you take. So my purpose maybe over the next 15 minutes or so is to look at some of that evidence, reference maybe some of the data that Gabriel has used in the initial presentation, and look at some of the issues in relation to Ireland, and particularly the role both in Ireland and internationally of US companies, and the scale and the amount of profits of US companies which are flowing through various jurisdictions, and the impact they have on various estimates of profit shifting. Just in terms of some context,
Seamus, I think your slides aren't visible there, I think. Apologies, just to...
All right, Barra.
Yeah, that's it there. It's just started sharing the screen now. So I think you can go full
It's
screen.
running
Yeah,
nice
yeah.
picture of UCC on a sunnier day than today. So just in terms of some context of the overall debate, so this is just looking at the contribution of corporate tax revenues to the taxes collected by the countries of the EU 15. So the main group of countries who would have formed an original block of membership in the EU. And that from the OECD goes back to 1965, when you can see that corporate taxes were around 6% of overall tax revenue, rose then as they got towards the turn of the millennium, fell significantly with the global financial crisis in 2008, 2009. And for the last number of years has been edging back up and is close to pretty much where it was a decade ago. And if you just look at it in terms of GDP, if you say that governments are collecting more in tax revenue, what is happening to the share of GDP when we look at it from a corporate tax revenue perspective? Again, for the EU 15, taking the arithmetic mean, so it's the outcomes for each individual country, and then just getting the average. You can see back in the 60s and 70s with around 2% of GDP. And it is a small bit higher now. It's probably closer to 3%. Again, a fall after the crisis of 2008, 2009, and a gradual rise back up towards 3% again. So revenues themselves as a share of total tax revenue are broadly in line where they have been recently, and also as a share of GDP. If we want to look at effective tax rates, we don't have as long a data, but again for the EU 15, we can look at the tax paid by non-financial corporates as a share of net operating surplus. It's a measure of profits. It's close to some of the accounting and tax measure of profits. And again, this is the arithmetic mean for profits in the EU 15 and the average effective tax rate in those. And you can again see from about 2000, it's been relatively stable, in and around 20%, a small bit of volatility. In fact, this is less volatile than the receipts, which suggests that the volatility of receipts is driven as much by profit reductions and increases as it is by the rate. So that the average rate on corporate profits in the EU 15 is remained around 15%. Of course, what we don't see from this is maybe the missing profits, which of course Gabriel has referred to. This is that the profits as reported in the countries of the EU 15, what's happening to profits in other jurisdictions and profits that might be rightfully located in other areas. So we have some macro data sources where we can look at these. Two of them have already been mentioned: Eurostat's foreign-controlled EU affiliates data, which gives data on all parent jurisdictions, so it covers wherever a company comes from, but only deals with its operations in the EU. So you have data on the extant 27 members of the EU, and you can get information about where those companies have their parent operations. Are they US companies? Are they European companies? Or are they from other parts of the world? The profit measure in that is gross operating surplus, linked to the one used in the previous slide. But from an Irish perspective, gross does throw up some exclamation marks, because that means before depreciation. So the impact of aircraft and intangible assets has a role there. The final one at the bottom, the BEA, that's US balance of payments data, that only covers US parent operations. So it gives you some information on the operations of US companies around the world. However, I would say that there is very dubious profit allocation to some jurisdictions in this data. As Gabriel said, the primary motive of the BEA is the US balance of payments. They're just primarily interested in whether stuff is inside or outside the US. The exact allocation to countries at times can be questioned. We might look at some of that in terms of why some of the larger figures for Ireland perhaps include profits that should be rightfully allocated elsewhere. And indeed, the companies themselves allocate that profit elsewhere. If you look at the middle profit source here, the OECD have recently started publishing data on the country-by-country reports that multinationals are now filing with tax authorities. So there's some basic information about revenues, profits, employment, and capital that have to be reported in a standard form. The OECD have now started accumulating statistics on these. I think a good bit of work has gone into it. And in the latest round, they published data for 27 parent jurisdictions. So we get the headquarters from 27 countries and across all the various jurisdictions, upwards of 200 separate country-by-country reports are filed for all their operations in various countries. Now, some are more detailed than others, so it is somewhat incomplete, but is a good start. And the profit measure here is taxable income. So looking closely at how much taxable profit the companies report in various countries. So given that we're looking at Ireland, here is data from the OECD country-by-country reports for operations in Ireland. So again, we have a starting set of 27 countries that this can come from. We'll exclude Ireland and look at those countries then that report their companies having profits in Ireland. So you've got France, Japan, Italy, China, through various other countries. And the large one thus far is France at just over $2 billion. The OECD data is put as dollar denominated. So clearly there's an issue with the scale and the one country that's missing. So we'll just move it on. We see that the US and US companies report outsized profits in Ireland relative to other countries. So this is 2016, you're looking at $31 billion of taxable income reported in Ireland by US companies, far in excess of anything reported by companies from any other country. So in terms of Ireland being a tax haven, one issue would be is why is it just limited to US companies? If we look at the Eurostat data, which covers all sources of companies in Ireland, you'd again see a similar picture. If Ireland has such accommodating tax laws, how is it doesn't seem to be taken advantage of by UK companies? They're only a couple of miles across the Irish Sea. We share a common language. And why isn't it taken advantage of by Euro area countries? We mightn't share a common language, but we share a common currency. Yet as we look at the list here, we see relatively small amounts from other Euro area countries relative to what's happening with the US. So clearly the US has a big role to play. And if you look at the OECD data and look at where US companies tell the IRS their profits are, so this isn't the BEA looking at company accounts. Are the companies filing reports with the IRS saying this is where our taxable income is generated. And these are them ranked from the largest to the smallest. And I suppose it's not a surprise to see some of the jurisdictions that are there. Right towards the top, we have Puerto Rico, perhaps close to being part of the US itself as a certain sort of protected jurisdiction, the Netherlands, and Ireland comes third, again with that total of 31 billion, although far less than the 100 billion we'd have seen previously. So this is the amount that the companies are telling the IRS they are reporting in each of these countries. If you look a bit further down, we see some other jurisdictions, perhaps different types of operations, what might be happening in Puerto Rico, the Netherlands and Ireland, which might be linked to pharmaceutical companies. If you look at this group here, we've Bermuda, the Cayman Islands and Bahamas, all of these north of 20 billion. The companies are telling the IRS we have 20 billion of profit, US dollars of profit in these island countries every year. This is 2016. They clearly have no substance there. And a further issue with the BEA data is that it actually excludes and doesn't have any references for the Cayman Island and Bahamas. The total profit is there, but nothing is allocated to these countries. And they have an amount close to zero for Bermuda. So the companies are saying in their tax data, tens of billions of profit in these island jurisdictions. In the BEA data, it's either absent or close to zero. And that's one reason the BEA allocate these profits. Once they're outside the US, their allocation to countries can be quite loose, and large amounts are allocated to Ireland, perhaps because some of these companies are Irish incorporated. They were established and registered here, but they are resident and based, whatever operations they do have, in Bermuda, the Cayman. We know that Google operates a holding company in Bermuda, and Facebook have been linked with the Cayman Islands. If we look at those tax jurisdictions, again, we can see the outsized role of the US. So this is the OECD data for the Cayman Islands, at 20 billion plus of profits of US companies, and essentially nobody else is appearing. It's primarily US profits in the Cayman Islands, and the same for Bermuda. Nearly 25 billion of profit reported, but it's not French or Danish or Italian or Brazilian or even Indian companies that are reporting that profit. It's all US profit. So significant amounts of profit being shifted there, 25 billion in 2016, but as one player, it's the US, and there's an absence of profit flows from companies that have their parent jurisdiction or parent headquarters in other countries. if we go back to the overall spread of US profits, again, you might look at the chart and say, why did you have the scale out so large? The largest number there is 38, 39 billion for Puerto Rico. But why have it going up to 125 billion? Because actually the largest location of foreign profits of US multinationals is nowhere. In official tax data, they tell the IRS that in 2016, they had $121 billion of profits that was recorded as stateless. So they told the IRS it was earned by entities that were resident nowhere. And they had no issue telling the IRS that it's part of the US system. The profits don't have to be located somewhere. And again, in the BEA data, this 120 billion of profit has to be allocated somewhere. Balance of payments compilers aren't going to have profit essentially on the moon. They're going to allocate it to a country. And that 120 billion gets allocated between various countries. It's not in the tax base of those countries, but does get allocated in the BEA data. And that's why you can get very large figures for certain countries that doesn't seem to reflect what's actually happening. If you look at stateless companies, again, it's just a US issue. Cayman Islands, Bermuda, we're just seeing US profits. If you look for stateless profits, a couple of countries report tiny amounts. Like they are bars, not lines, but the 121 billion is all US. So there is an issue with stateless income and stateless profits, but it's primarily a US issue. They have a tax system that facilitates companies to have profit by them deemed to be offshore, but then be onshore nowhere. So it is shifted out of the US. It is as a result of R&D and innovation and brands and reputation that are derived in the US, but it's not in the tax base of any other country. And of course, this type of stateless profit was central to the Apple state aid case in the European Union, where the European Commission made a determination that a large share of a stateless income should be taxed in Ireland. But as we know, the European Court of Justice recently overturned that finding. And then if we look at just cumulatively putting all that together for various jurisdictions, so the cumulative amount of profits in the Bahamas, Belgium, Hong Kong, Ireland, Luxembourg, Netherlands, a whole set of countries, and see like, where does that profit come from? Again, we see that the same picture. Who is reporting profits in these no or low tax or questionable jurisdictions? Well, by and large, it's US companies. Yes, maybe there's some amounts of French, Chinese, and Japanese profits appearing, but in the OECD country by country data, you have $350 billion worth of profit in these jurisdictions from US companies alone. So if you have estimates of 500 or 600 billion of profits being shifted through various arrangements, the bulk of it arises from US companies and is a profit itself that originates from activities that take place in the US, not the market countries. And then just to conclude a bit about what happens to these profits, well, in these low tax jurisdictions, obviously very little tax is paid. If you look on the bottom of this table, you have that 120 billion of profit recorded in stateless entities. They have a tax rate of less than 1%. The Cayman and Bahamas don't have corporate income taxes, so unsurprisingly, the implied effective tax rate in those countries is 0. In Ireland, on that 31 billion of profit in 2016, they paid about $4 billion of corporation tax, or an effective rate of 14%, given the blend of rates in Ireland. And does this matter from a taxing perspective? Well, in 2016, it probably did. Nobody was collecting the additional tax on those 0% rates. The US had a worldwide regime that would have collected some tax if the money was brought back into the US. That didn't happen. But now we have a significant revision to the US regime from the Tax Cuts and Jobs Act of December 2017. And while there are a significant amounts of US profits in low or no tax jurisdictions, the previous US deferral provisions have now been replaced by a new minimum tax payable as profits as they are earned. Somebody had a bit of fun when they came up with the acronym for it. And this is the GILTI provisions in the US tax code, Global Intangible Low Taxed Income. And if US companies, as they are generating low effective tax rates by shifting intangible related profits around, they do have to pay a minimum tax to the US. So if you look at the tax outcomes for companies. Yes, you can get low effective tax rates on foreign profits, but that tax will be topped up with payments to the US. It'll appear as domestic US tax. So for example, you can get effective tax rates of less than 10% for the foreign earnings of US companies. But even with the headline rate at 21%, the domestic effective rate of tax could be north of 30%, because the 21% will be charged on the profits earned in the US, and then the top-up tax on those foreign profits will also be charged in the US. So if there is to be additional tax paid on these US profits that are flushing around at these various jurisdictions, which the US has allowed out, whatever about certain countries being a tax haven, there is no doubt that the US is a profit sieve. It is allowing significant amounts of profit to escape from its tax base and has to make efforts then to try and get it back in, which is done through these GILTI provisions. The largest amount of the tax that is due to the US, and if additional tax is paid elsewhere, it will result in lower tax being paid in the US. And that is me.
Great. Thank you very much, Seamus, for that. So great to have, we have tax havens now, profit sieves, and then GILTI legislation. So all the acronyms are building up. And so we'll hand over now for our final speaker of the session on the opening statements, and then we'll have a discussion. So do please keep your questions coming in. Hand over now to Ashling Donohoe. So Ashling is a partner at Andersen in Ireland, and she has significant experience with international structuring, mergers, acquisitions, EU law-based claims, and she's an expert on the issue of corporation tax. So she's going to give us more, I suppose, of a practitioner's take on these things, and maybe tell us why we're worrying about the wrong thing or the old problem. So Ashling, thanks very much.
Thanks, Barra. Yeah, so I've been having some IT problems here, so I'm not sharing my screen. The guys at Trinity are dealing with that, so I'm going to have to keep asking them to change the slide for me. So the question is whether Ireland is a tax haven. And I mean, I think the starting point there should be that we need to define what a tax haven is. So can you move the screen? Thank you. So traditionally, the countries that we think of instinctively as being tax havens might be countries with low headline rates. Ireland would be a classic example there with our 12.5% corporation tax rate. But many people are surprised to discover that we actually have a 25% corporate income tax rate and a 33% corporate income tax rate applicable to different kinds of income. Another definition might be a country which permits a very narrow tax base. So you will notice that when Gabriel was referring to tax havens, he was talking about countries with low tax rates, but then he was talking about countries like the Netherlands and Luxembourg. And the Netherlands and Luxembourg traditionally have high headline tax rates. They just have agreed rulings with taxpayers, which allowed the tax base to be narrowed so that a high rate was being applied to a small amount of income. Another and probably more classical definition of a tax haven would be a secrecy jurisdiction. Those would be traditionally places in the Caribbean, or, you know, Switzerland historically would have been considered a secrecy jurisdiction. Those would be places that don't share data, that have strict bank secrecy laws. Another definition, again, if you look to the OECD, will be countries that have a lack of transparency about what they're doing, and there tends to be a significant overlap between secrecy jurisdictions and countries with transparency issues. Another thing we might look at would be a failure to comply with binding international obligations. And in that regard, it's quite amusing that if you look, for example, at the OECD multilateral instrument and which countries are planning on applying it and what reservations they have expressed, so where they're not planning on applying it, it's interesting to note that countries that might be traditionally perceived to be tax havens, like the Netherlands and Ireland, have made very few reservations. We're pretty much accepting it in full. And countries that are traditionally not considered to be tax havens, like, for example, the UK and Germany, have made significantly more reservations than we have, which means they're only going to apply it in part. If you look at, there's some EU legislation called ATAD, the Anti-Tax Avoidance Directive. And if you look at the countries that are complying with that, you will find, again, the countries that you don't traditionally associate with being tax havens, like Germany, are not necessarily implementing aspects of the law that Ireland is, for example, implementing. So, you know, oftentimes when we say tax haven, what we mean is a country which has a materially different approach to tax policy than yours. Or, you know, rather jokingly in the tax profession, I've been offered the following two definitions. One of my friends suggested anyone but Sweden is a tax haven. And somebody else suggested that we should use the definition that if a country has publicly denied being a tax haven, they probably are a tax haven. And you will find that that actually includes countries like the UK. So if we go on to the next slide, please. So in terms of applying those tests to Ireland, Ireland has traditionally offered low headline rates, but what often comes as a surprise to people is that people associate Ireland with the 12.5% tax rate, and they think it was a tax cut because the headline rate at the time for non-manufacturing relief, non-IFSC profits was in the high 30s. But actually, before the 12.5% tax rate, a lot of inbound investment in Ireland benefited from a 10% tax rate if those companies were engaged in the IFSC, in the Shannon area, or in manufacturing. And the 10% rate itself replaced something called export sales relief, which was a 0% corporate tax rate, which Ireland used to apply before we joined the EU, and the EU said it looked an awful lot like a state aid. So if you actually look at the history of the Apple tax case, Apple originally paid no tax in Ireland because they were eligible for export sales relief. So they had a 0% corporate tax rate. The EU said Ireland had to get rid of the 0% corporate tax rate, which meant Apple was going to have to start paying tax in Ireland. And Apple then had discussions with the Irish authorities as to what tax on what profits it should be paying. But Ireland has had a very low tax rate applicable to some or all corporate profits since long before we joined the EU with export sales relief. And yet that didn't lead to Ireland becoming massively wealthy or generating huge amounts of corporate income tax. All of that came later in the late 90s, early noughties. And so sometimes it might be worth stopping to question whether the tax rates applicable in Ireland actually explain the entirety of what's going on there. So as well as having a low headline rate, Ireland has in the past facilitated a narrow base and low effective rates with companies like Apple. So those are two indicia of tax havens that Ireland might meet. Ireland is definitely not a secrecy jurisdiction. It has no issues with legal cooperation or data sharing with other tax authorities. So it certainly doesn't look like a tax haven on that one. We have always sought to be transparent. For example, commissioning the spillover analysis in 2015. So again, that on those grounds, the Irish government is quite determined that we are not a tax haven. And I think it is important, if you're going to talk about what a tax haven is, to define what that means, but also to understand that if when I started in the world of tax 20 years ago, someone spoke of a tax haven, they were almost certainly talking about Belize or BVI or Bermuda. They were talking about a secrecy jurisdiction with no tax. And nowadays, the term tax haven is being bandied around to cover many, many more jurisdictions and for multiple different reasons. So recently, both Mongolia and Namibia found themselves being branded as tax havens for entirely different reasons. Now, they both got removed off the tax haven list, but instinctively, most of us don't think of Namibia or Mongolia as tax havens, and yet they did meet the criteria that some institution was applying. So if we go on to the next slide. So why does it matter whether Ireland's a tax haven or not? I honestly don't think it does. It's a pejorative phrase designed to shame countries into acting in a particular way. So as I said, when I started in the world of tax, it was sunny islands in the Caribbean who didn't share data and didn't tax income. Nowadays, and this is one point that I'm going to keep repeating, the world of tax has changed massively in the 20 years that I've been working in it. The work that you would have done as a corporate tax practitioner in 2007 versus the work that you would be doing as a corporate tax practitioner now is hugely, hugely different. And an awful lot of the structures that people are getting visibility to now, structures like the Apple structure and the Starbucks structure and the McDonald's structure and so forth, were structures that were put in place in a different era, and you wouldn't put those structures in place these days. So there is an almost universal consensus internationally that base erosion and profit shifting are bad and that they undermine the public trust in the political system. There is a pretty broad consensus now that the tax rules that were designed, up until the 1970s and even later than that, simply did not cope with the digital economy, and that they need to be revised. There is a far greater understanding of how cross-border tax arbitrage works. So if I can just explain what cross-border tax arbitrage is, it's where you have an expense that is deductible in one country and not taxable in the country where the income appears, or it might be an item that has a different tax categorization in two different countries, but it's using the tax rules of one or more jurisdictions in order to create a tax advantage. And it used to be the bread and butter of my profession, and for some reason people didn't like us doing it. So in terms of why does it matter whether someone's a tax haven or not, one of the answers is that it takes two to tango. And as you may have already gotten the impression from Seamus's presentation, it usually takes three to tango because almost certainly the US is implicated one way or another. So most of this tax planning that you see, particularly in Ireland, but if you look at the state aid cases, an awful lot of them involved US-headed multinationals. That wasn't by accident. It was because the way the US tax system worked was that it allowed these structures to work by having inefficient controlled foreign company rules. So, for example, if you had a German-headed group or a French-headed group, and there was a big pot of stateless income somewhere, Germany or France, under their controlled foreign company rules, would have taxed that income. The US intentionally did not do so. And so as a result, you tended to see more aggressive tax strategies in US-headed groups than other groups because the parent jurisdiction was not imposing a minimum corporate income tax in the way that European headquartered companies would have suffered. So I just want to briefly touch on the GE case in the UK at the moment. I don't want to go into it in too much detail because it's not beyond the realms of possibility that it's going to lead to criminal proceedings at some stage. But what happened in the GE case was that in approximately 2002, GE decided that they were going to buy an Australian group. And rather than having the US parent company buy the Australian group or having an Australian subsidiary buy the Australian group, they had their UK subgroup buy the Australian group. And the way that this was structured resulted in a tax deduction being available in Australia, a tax deduction being available in the UK, and the corresponding interest income not being taxable in Luxembourg. And because GE was US headed, this tax-free income was rolling up in Luxembourg and the US wasn't taxing it under the US CFC rules. So what apparently has happened, but we're kind of basing this on things that are coming out of litigation and some press coverage in the UK, is that the GE tax team appeared to have told HMRC in the UK that some of the structuring involved was in order to create an Australian tax advantage. And they appear to have told the Australian tax authorities that the same structuring was in place to create a UK tax advantage. The Australian tax office picked up the phone to HMRC, and HMRC are now trying to rescind on agreements which they made with GE in the UK, and that's where the litigation is going at the moment. They're effectively saying that the GE tax team misled them in 2002, and that's why they agreed to not tax the transaction. So in that case, you can single Luxembourg out for name calling. You can call Luxembourg a tax haven if you want to. There was a load of interest income and Luxembourg didn't tax it. But what's actually achieved this transaction at least being considered, if not taxed, because we won't know the final outcome for some time, is tax authorities working together, tax authorities sharing data with each other, and a developing international consensus on designing new rules. So, I'm not a huge fan of the idea of calling companies or calling countries tax havens, because in this instance, Australia has already settled with GE. The UK is seeking to settle or to tax GE. The US has subsequently changed its rules, and Luxembourg would not give the ruling that it would have given at the time that this transaction was put in place. So name calling hasn't achieved much, cooperation actually has. So if we go on to the next slide. So again, why does it matter about calling countries tax havens? The first point is that, you know, you need different medicines for different illnesses. There isn't going to be a globalized, harmonized corporate income tax that all countries are going to sign up to. That's simply not going to happen. Countries have their own electorates and their own ideals. And countries will always pursue legitimate policy choices through their tax code. And for those of you who were Irish on the presentation, countries will also pursue completely bonkers policies through their tax code, like, for example, incentivizing the building of massive amounts of holiday homes in Longford or Roscommon or wherever. But countries will determine that they want to funnel investment into a particular area, and that may be something as insane as the Rural Renewal Scheme, and they will do that. And that doesn't necessarily make it bad, and it doesn't necessarily have an impact on anyone else's economy. So it could be that the Germans want to incentivize capital investment in infrastructure. It could be that Ireland feels its economy is overheating and, unusually for Ireland, decides to try and cool the economy down through fiscal adjustments rather than trying to heat it up more. If you're looking at secrecy jurisdictions, unlike conduit jurisdictions, those jurisdictions facilitate tax evasion and money laundering. So if I have money hidden in a bank account in Honduras, because I know Honduras will not tell the Irish tax authorities about that money, it doesn't matter what changes you make to the law. If I've already decided to commit a crime, I'm not going to comply with any new law that you put on me, because, you know, these are not the kind of people who try and comply with laws. Whereas if you're looking at corporate tax planning and conduit jurisdictions, if you're looking at the likes of Apple, then if the laws change, Apple will try to comply with those laws. So something can be achieved when you're dealing with large corporates engaged in tax planning. You won't achieve the same things by the same means when you're talking about high net worth individuals actually actively hiding money from the government. And so when you're in the realm of individuals and tax evasion, or even corporates and tax evasion, you need very different policy tools. You need legislation like FATCA, which is US tax legislation, or the common reporting standards, because you need to force the financial institutions, you need to force the third parties to share the data on the basis that the underlying taxpayers may not be minded to comply with the law. So if we just go on to the next slide there. So I did say that I think there's an element of us holding yesterday's debate today. I was having a conversation with a Dutch tax colleague. Sorry, I've skipped a slide. Yeah, I was having a conversation with a Dutch tax colleague last year, and he asked me, when was the last time you were asked to put a sexy financing structure in place? I think I replied about 2007. And he asked me, do you ever expect to put one in place again? And the answer was no. The tax profession has moved on. The structures that people are getting annoyed about now are not the structures that are being put in place now, but they're the structures that are getting visibility now. So, you know, there's an element of the world is moving on, and a lot of these issues are being addressed, but the consensus, the new legislation that's addressing the issues isn't flowing into the data just yet, but we expect it to start flowing in shortly. So I've got one or two little tax acronyms here for the crowd. We have TARS, which are Targeted Anti-Abuse Rules. That's where the tax legislation has a specific clause to try and stop itself being abused. So for example, the UK had a rule about taking on corporate debt for a disallowable purpose. The rule came in 1996, but HMRC never took a test case until about 2009, 2010. So the rule was always there. As a practitioner, you kind of ignored it because you never thought anyone was going to use it. HMRC started using it in 2009, 2010. They had a lot of success and they use it all the time now. So people are far less sanguine about pushing corporate debt into the UK now than they would have been in the past. The next acronym we have is GARS. They're General Anti-Abuse Rules. And under ATAD, under the Anti-Tax Avoidance Directive, which is a piece of EU legislation, all EU member states are now obliged to have general anti-avoidance rules within their tax code. Ireland, surprising for most people, has one of the broadest GARs in the world. We brought our GAR in 1989, and the first Irish Supreme Court case with our GAR was in 2011. So much like the UK experience, tax professionals kind of ignored that it was there for a while, but you don't ignore it now. So
just bring it towards the end.
Yeah. Okay. So just we have, there are an awful lot of developments on an international level, on an EU level, including, for example, country by country reporting, where tax authorities are getting a lot more data to see what's happening with all of these profit flows. So there are developments that have happened recently. Those should start feeding into the numbers shortly. There are other developments which are in the process of being agreed at the moment. And the major issue is the US. The US has always been the problem to agreeing consensus for international tax reform. We have to wait and see whether the US will continue to be a problem now.
Great. Thank you very much, Ashling, and thank you to all the speakers there. I think really good kind of overview of some of the big issues involved here. So we've got a load of questions that have come in now, and hopefully we've got a good amount of time, about 30 minutes for discussion, so we can kind of go back and forth hopefully across that. So one question which maybe is not a bad place to start is one that's come in, and so asks essentially, how do we marry Gabriel's findings that essentially there's lots of missing or untaxed profit from places like Spain and France, which is ending up in places like Ireland, with Seamus's points that essentially that this is a US, primarily driven by US policy, that US is this profit shift. So Gabriel might start off with, go back to where we started on that, and you might tell us whether, how do you kind of see combining what your findings have shown with those of the points that Seamus was making about this being a lot to do with US policy?
I think this is very consistent. That is what we find in our paper, The Missing Profits of Nations, is indeed that US multinationals account for more than 50% of global profit shifting. So there are two different questions. There's one question, which is which multinationals shift profits? That's one question. And the other question is, out of which countries are profits being shifted? So who are the losers from this process? And what we do in our work is that we consider both questions. So basically, the results that I presented, I focused on out of which countries are being shifted, and so there's a significant amount of profits shifted out of countries like France, countries like Germany, and so revenue losses for these economies. But a lot of these profits that are being shifted out of these countries are shifted by US multinationals that operate in France and Germany, shift those profits to places like Ireland or Bermuda. So it's clear in the data that US multinationals play a big role. I would not say that this is only a US multinationals phenomenon. There's profit shifting by multinationals from all countries. You look at French multinationals, they do shift profits, in luxury. You look at automakers, Fiat in Italy. You look at many cases that have been brought forward, by the European Commission in particular. So it's not only a US multinationals thing. The 2016 country-by-country data that were recently released by the OECD are very incomplete, as emphasized by the OECD. Reporting was limited in many countries other than the US, and so it looks like there's mostly profit shifting by US multinationals in this data, but that's mostly a reporting issue. 2016 was the first year ever that multinationals were asked to report country-by-country information to their tax authorities, and then that this was centralized by the OECD. We need more years of data. Already in the 2017 data that were released in the US, we see actually a huge increase in profits booked in low tax jurisdictions as compared to 2016.
Okay. Seamus, do you want to come in maybe on that?
Yeah, I guess I suppose there continues to be sort of the sort of, not necessarily a contradiction, but the idea that US companies can shift profits out of France and Germany to countries like Ireland, but French and German companies can't do it. If it's possible to shift profits from activities you have in these countries to other tax jurisdictions. Why aren't the French and the German companies doing it? Why aren't we seeing them having similar structures? I think Ashling would have gone through some of that in relation to the rules that apply to US companies, and it's the ability to get profits out of the US initially. It's not that these profits originate in Germany and France. That's where these companies have their customers, where they sell their products. But the actual profit generating apparatus is in the US. If you were to say, where should the profit rightfully be attributed, it should be where these products are developed, where the R&D takes place, where the brand is maintained. And a lot of that activity happens in the US. Now, the US allows the profit to leak out. It has an unusual approach to transfer pricing, particularly licensing and cost sharing agreements. And that's why you see the profit being located in jurisdictions where there's no substance. They can move the profits to stateless entities, to entities in the Cayman Islands, because it's all linked to license, it's all on paper. So it shifts out of the US and then moves to those no tax jurisdictions where they have no substance. And the US, in a sense, is pretty pleased with that. It can't stop the profit getting out. It probably should have considered it with the Tax Cuts and Jobs Act, but they went for this global minimum approach with the GILTI. So they're allowing the profit to get out, and then they want to charge the GILTI tax to try and collect some tax revenue. And like with the Apple state aid case, like serious concerns were raised by the US Treasury that the European Union was trying to get money to be taxed by a EU member state that rightfully belonged to the US. So I think the argument that the profit generates in France and Germany doesn't stack up. Why aren't those companies doing the same as US companies? The profit starts in the US, gets out, and ends up in lower no tax jurisdictions, but it's US source profit, not customer source profit.
Ashling, maybe do you want to comment? So is there a reason why European firms aren't using the same vehicles that the US seems to be, or does it? Oh, I'll unmute you there, or asked to unmute. There you go.
Yeah. I mean, an awful lot of it traditionally was subpart F. And for an interesting historical context, I mentioned that Ireland used to exempt, used to have something called export sales relief, which means that if you manufactured stuff in Ireland, as Apple did, and you sold it outside of Ireland, you didn't have to pay tax on those profits. Now, the US used to have a similar regime. They had the DISC regime originally, and then they replaced it with the Foreign Sales Corporation regime, the FSC regime. And in the late 90s and up to 1999, the EU took a series of cases to the World Trade Organization saying that these tax exemptions on profits from foreign sales were in effect an illegal trade subsidy to US groups. And in every instance, the EU won. And then the US finally abolished foreign sales corporations in around 1999, 2000, just at the start of my career. And that kind of aligns nicely with the growth in these stateless profits appearing in Bermuda, in Ireland, or being partly attributed to Ireland or partly attributed to Luxembourg or Netherlands or whatever else. So, you know, it is possible that it has suited the US to turn a blind eye to the fact that these profits are being generated and not being taxed, because in a world before the EU beat the US in a WTO dispute, the US wouldn't have taxed these profits anyway. And it wouldn't have taxed these profits intentionally to create a subsidy for US companies selling outside the US, which, you know, many jurisdictions did in that era. Okay. But most jurisdictions don't now.
Okay, so Gabriel, maybe kind of come in on that. So the Apple example of products always seems kind of an illustrative one, in that what you're saying essentially is that their sales from, say, Apple products or in France, Germany, Spain, whichever, which are ending up being booked or coming through Ireland at least, and in the data you have really should are being going there, and you're saying they're being shipped across. Are those not ultimately US profits? I mean, is it the case that those profits should be taxed in France or Spain? Shouldn't they be US as taxed in that they come from the IP, and the reason people buy those Apple products is because they're shiny and pretty and all the rest, rather than because, you know, they're sold in France?
So what I'm saying is, if all countries had the same tax rate, there would be much less profit booked in Ireland, and there would be more profit booked in France, Germany, and also in the US. it's hard to know, exactly which proportion the shift would occur. We try to provide estimates in our paper, and what our findings suggest is that there would be significantly more profits actually in the main continental European countries. So they would be kind of the main winners from a full tax harmonization. There would be somewhat more profits in the US as well. There would be much, much less in Ireland. And how do we arrive at that result? Just to make things very clear and transparent, there is a large body of evidence that significant sums are being shifted by US multinationals in Ireland. Everybody agrees with that. And then when you look at transactions in the Irish balance of payments, transactions that have been found in the literature to be conducive of profit shifting. When you look at exports of the right to use intellectual property, when you look at exports of management services, when you look at exports of financial services, intra-group exports, you see a lot of these exports from Ireland to continental European countries. And that's through these exports, as we call it in balance of payments, that the profits are being shifted out of the continental European countries. And so what we're saying is that if all countries have the same tax rate, these intra-group exports of services would disappear. And so there would be more profit in Germany, in France, and so on. But I agree that this is hard to quantify. And I have nothing to say about the legality of the intra-group transactions that are being conducted today or that have been done in the past, or whether what Apple did was legal or not. I don't know. I'm not a lawyer. What I know is that if we had a full tax harmonization, which is possible, we could choose a different form of globalization. We have one form of globalization that's characterized by tax competition. We could have another form of globalization characterized by tax convergence, tax harmonization. What I know is that in this alternative globalization, the geography of profits will be very different.
So Seamus, that there seems to be agreement that the geography would be different, but would it be more in, do you think it'd be more in European countries, or is this a kind of American profits that are avoiding tax through various travels around the world?
Well, even if you have complete harmonization of rates and rules, you're still going to need some mechanism of allocating profits. And the current approach is that profits are allocated on the basis of risks, functions, and assets that generate those profits. And intra-company transactions are priced, that should be priced anyway to reflect that the risk, function, and assets that generate the profits. Unless Apple start doing R&D in Germany, the amount of profit they earn there isn't going to increase significantly. What Apple do in Germany is sell phones. Selling phones is not a profitable activity. Consumer electronics retailers go bust on a very regular basis. Designing a phone that people want to buy is where the profit is. And unless Apple moves its design, its research, its product development, its innovation from pretty much close to Gabriel there in California and moves it to the Ruhr Valley, it's not going to be paying additional significant tax in Germany because it won't have its profit generating activities there. Now, we could change the rules and say more tax should be paid where customers are, and there's a certain legitimacy to that when it comes to digital companies. But if we're going to continue to tax profit-making activities where they take place, Apple's profit-making activities take place in the US, and that's where the tax should be paid. That the US lets the profit out, and up to recently it was hidden in stateless entities, at least hidden to the rest of the world in stateless entities, is a matter and a function of US tax law. But the profit-generating activities do take place in the US.
Maybe just quickly come back to you, Gabriel, on that. Would you agree then from the point of view of, so Apple is, I suppose, the big one here, one of the big ones, that it really is under the current system of no matter, even if every country did have the same tax rate, that really it's I suppose, it's the US that is not taxing those profits, and that it's not really Germany or France or Spain aren't losing out?
So 2 points. One is you can come up with lots of reasonable answers to that question. The way I try to answer these questions is by looking at the data, and in particular at intragroup exports of services to allocate the shifted profits to presumably the places where they would be booked if there was a food tax harmonization. So I'm trying to, you can tell lots of plausible stories, but looking at the data kind of constraints, what you can say. And that's what we found by looking at this data in a systematic manner. Second, I think this question, frankly, is not extremely relevant. What's relevant, the most important question is how much does a company like Apple pay in taxes, and how much would it pay with a food tax harmonization, and whether the extra taxes would be paid in the US or in Germany or in France strikes me as less important than whether in the 21st century we're going to make sure that the largest companies on the planet with trillions of dollars in market capitalization actually pay a decent amount of tax. And so that their shareholders through these firms actually pay a decent amount of tax. That's what really matters. What matters is not in which country gets to tax part of Apple's profits. Is we need to make sure, for the sustainability of globalization, we need to make sure that the main winners from globalization, the big multinational companies and their shareholders, actually pay more in taxes rather than paying less and less. Because if they pay less and less, then I think everybody understands that it's not sustainable, neither politically nor economically. It's not going to end well, it's not sustainable. So that's the really important question.
No, I think that's absolutely right. I mean, it may influence how heavily certain countries are pushing for it or not. But yeah, absolutely. I think probably most of us can agree on that. Actually, maybe just come back to something that you said, and one question that we have in here is in relation to can it be seen then what the US's failure to tax a lot of that profits and to allow kind of seep out, that's a still type of a state aid, or?
So this is one reason why I do think that Margaret Vestager was less insane than people thought she was using state aid as an approach to the US multinationals, because if you look at the groups that benefited from having stateless income, the vast majority of those are headed by US multinationals, particularly because of the way that Subpart F worked. So if something is a subsidy, then it does kind of feel like it might be within the realms of state aid. The issue with a lot of the state aid tax cases was the precise manner in which the Commission actually took them, or when the Commission looked at the tax laws in question, which laws it took issue with. So, for example, the Commission took a case against Belgium on the basis that a Belgian tax regime was a systemic aid, that everyone who benefited from a ruling under that system had received a tax state aid. They lost in the General Court, but what the court actually said was that the Commission had to look at each individual taxpayer. If you look at how Ireland has currently won in the Apple case, but if you look at how Ireland won in the Apple case, Ireland argued that particular particular international tax rules, the OECD transfer pricing rules, had always applied in Ireland, despite the fact that when Ireland legislated for those rules in 2009, I think, Ireland specifically said they didn't apply to transactions that predated 2009. And yet there Ireland is rocking up to the General Court saying, yeah, but these rules always applied anyway, which could be used for other US multinationals with operations in Ireland. In that, if they thought that their royalty payments didn't have to be transfer priced on the basis of the OECD transfer pricing guidelines, they may now have to revisit that. So, I think there's more to come from the EU state aid tax cases. I wouldn't be entirely surprised if some of the cases were reversed on appeal to the Court of Justice, and obviously some more of the cases haven't made it to court yet at all. But if you look at this pot of stateless profits in the hands of US multinationals as providing, in effect, a subsidy to US multinationals, then the European Commission attempting to use the state aid rules, which, are to stop state subsidies, doesn't necessarily seem to be entirely the wrong tool for the job.
Okay, so we've got about maybe kind of 10 minutes or so, 5-10 minutes left for discussion. Maybe we can turn towards what Gabriel pointed was one of the big issues. How do we move towards a system whereby more tax is paid by those multinationals, and how do we get there? So we've got one question saying, is it through the multilateral agreement and corporate tax reform through the OECD, or are the US administration, maybe outgoing, maybe not, is that going to make that more difficult? What is the best path forward there? So maybe Gabriel, will start with you on that and then come to Seamus.
Yeah, I think it's a very important question. So I think that obviously the solution involves an international agreement, international cooperation. But once you've said that, you've not really said much, because the question is how you get there. And what history suggests and past experience suggests is that the way to get to an international agreement is initially through sometimes unilateral action. A good example is what happened with bank secrecy around 2010. So before the financial crisis of 2008, 2009, Swiss banks refused to exchange bank information with other countries' tax authorities. And at the time when you said, oh, look, they should be forced to send data, to help other countries fight against tax evasion, the answer among experts and almost everybody was, that's impossible. How do you want to force Switzerland to do this if they have their bank secrecy laws? That's their sovereign right, and there's nothing that can be done. Well, except that things changed when in 2020, President Obama basically said, look, you have to send us information, otherwise you will face economic sanctions, like a tax of 30% on all interest and dividends paid by the US to Switzerland. And under the threat of this policy, Swiss bankers agreed to exchange information with the US, and this paved the way for a new form of international coordination, the automatic exchange of bank information, which now is a reality, which now exists. And so you see how in less than a decade, new form of international coordination that were thought to be completely utopian and impossible, like 10 years ago, I remember that's when I started working on these issues, they can materialize these new forms of international coordination in a short period of time. And so in applying that logic to the case of the corporate income tax, I think one way forward is for countries like Germany, let's say, to start collecting the tax deficit of multinational firms. What's the tax deficit of a multinational firm? It's the difference between what this firm should pay if it was subject to a minimal tax rate of, let's say, 25% country by country, and what this firm actually pays in taxes. So now with the country by country data, any tax authority can compute the tax deficit of each multinational company. And then any country, can start playing the role of tax collector of last resort. So for instance, let's say that Apple has a 10 billion euros tax deficit. Any country can compute that and makes 10% of its sales in Germany. Then Germany could say, look, if you want to have the access to the German market, we are going to collect part of your global tax deficit. We're going to collect 10% of your global tax deficit. So 1 billion euros, that's what you have to pay in extra taxes in Germany. And you see how with a logic like that, this can very quickly change the nature of tax competition, because if countries started collecting the tax deficit of multinationals, there would not be incentives anymore for tax havens to offer very low tax rates. You would see countries actually increase their tax rate. And finish with that, you would move from a form of globalization, which is a current globalization characterized by the race to the bottom, tax competition, to another globalization characterized by a race to the top, an increase in the corporate income tax rate. And I think that's doable initially through unilateral action.
Seamus, maybe is that the way forward, do you think, or should we place our faith in kind of a long and arduous multilateral process?
Well, I think that any changes that are introduced to have effects like that have to be done on a multilateral basis. I don't think you're going to see whatever outcomes you're looking for if a unilateral approach is taken and everybody introduces their own approaches, so like digital sales taxes, you see them happening at individual level of countries. That's essentially just adding to uncertainty, complexity. It's very difficult to get the agreement across countries. But like when it comes to companies paying tax and whatever it might be, the evidence suggests that the corporate tax revenues aren't falling. We might have significant issues with some of the structures that companies are using. But if you look at the actual tax revenue receipts of governments for corporation tax, they are stable or rising. And companies like Apple, while a bit of a poster child for tax avoidance, do pay significant amounts. And most of it is paid to the US. In the last 10 years, Apple would have paid about $100 billion in cash tax payments. Again, most of that to the US would have had an effective accounting tax rate of 23%. So if you go for a minimum tax rate of 25% and the company has a tax rate of 23%, the gap isn't that large. But there's no doubt that differences can be introduced. And I think there is a strong argument for digital companies for changes there, that some of the risks, functions and assets that companies use are their customers. So actually having us online and having our eyeballs tuned to their website is worth something to companies. And the location of the eyeballs doesn't matter there. But like when it comes to tax revenue, I think governments are collecting a lot. And it must be remembered that the corporate tax is our first dib at collecting tax from corporate profits. Yes, we want to tax the source of those profits, and we can also tax the shareholders. And maybe there's as many and more holes in personal income tax codes that when the shareholders earn profits, either capital gains or distributed dividends, that our ability to tax those streams on the residents of the shareholders has as many, if not more holes than the corporate tax on the source of the profits.
Yeah, no, I think I remember there was a randomized trial done over in the UK on self-employed taxpayers, and they found, I think, 50% to be non-compliant at a significant sum. So for sure, corporations aren't the only place where tax is going missing, could be patched up. But Ashling, how then do you think do we get to a position where companies do pay a higher more tax on their profits, wherever it be?
I'm puzzling at this. I'm puzzling at the idea that anyone would suggest that companies should just pay more tax on their profits wherever it may be. I mean, we tend to levy taxes in order to spend money. There tends to be some kind of link between government priorities, tax and spend. So, you know, if you are a French person and the US changes their CFC rules so that the US taxes more of the income that related to the sale of an iPhone to a French person, yes, the Apple will pay more tax overall. They will pay more tax in the US, but the French voter who has been led to believe that Apple is engaged in aggressive tax practices in France is not necessarily going to be particularly happy about that, and nor is the French politician. So this idea that companies should just pay more tax wherever and that would be okay just sounds slightly bizarre to me. Each jurisdiction should want to levy taxes to pay for services for their own voters. And that is going to require some kind of global consensus to arise. But, you know, I don't think that the EU or indeed European taxpayers or European politicians would necessarily be ecstatic by the idea of US multinationals paying significantly more tax in the US from the point of view of revenue raising. They may approve of it from the point of view of removing a subsidy or a competitive advantage which US firms currently have. But I don't think in terms of paying for roads, schools and hospitals, it's necessarily going to win many fans over here. So.
Okay, so just coming out of time, Gabriel, maybe just one last question to you. I suppose what one person's kind of asked in about essentially is by putting kind of calling out certain countries and calling them tax havens, is that the best way to go about achieving the aim that you speak of getting that, of raising the effective rate on the multinational companies, or is it better to go about building that multilateral consensus? So just kind of maybe finish up again on just that, on the issue.
Look, I think that the way to make progress is obviously it's not to demonize this or that country. And with globalization, all countries are becoming small compared to the planet as a whole and are acting as tax havens of sort in certain areas. That's true for Ireland, that's true for France, that's true for the US, that's true for all countries. The temptation just to kind of attract activity or profits or tax bases by using certain policy tools that are going to relocate this activity or this profits at the expense of other countries, the temptation is just very high everywhere. And so all countries are using policies of that type. So we are all tax havens. That's the current situation, some more than others. The temptation is stronger in the smallest countries, because when you're a very small country, then you can really win a lot of activity, attract a lot of activity, gain a lot of tax revenues by playing the game of tax competition. If you're a very large country and you start cutting your corporate tax rate, for instance, you're going to attract a bit of activity from the rest of the world, but you're going to lose a lot of tax revenue on the domestic tax base. The domestic tax base in big countries is very large compared to what you attract from the rest of the world. So the temptation to become a tax haven is less strong in large countries. But as I said, all large countries are becoming smaller and smaller, compared to the planet as a whole. So the only important question is, can we do better? Do we really think that this is the best type of the most sustainable form of globalization that we can have? The average global effective corporate tax rate has declined from 48% in 1985 to 22% today. Okay, if this continues, if the trend continues, it's going to become zero by the middle of the 21st century. Corporate tax collection has not collapsed, but that's mostly because there's more activity in the corporate sector, compared to the 70s, 60s, less activity in the non-corporate sector. There's been a huge increase in profitability. There's been an increase in the capital share of corporate value added. And so we should have seen a big increase in corporate tax revenues, and that's not what we've seen. My only point is that I don't think that's the best we can do. I don't think that's the most sustainable form of globalization we can have. And we need to think harder about alternative, more sustainable path for the future.
Okay, well, I think we're just about come to time. So I'd like to conclude by just thanking our speakers for what were really interesting presentations, and that you can keep more than 200 people at Irish time after 5 o'clock talking about corporation tax over Friday when we're all stuck at home and don't exactly need to go far to the nearest bar is maybe not, is some testament to how interesting that discussion was. So I'd like to also just finish up by really thanking everyone who helped make the Dublin Economics Workshop this year happen, in particular to Sarah Condon and to Maeve at TRIS, the Trinity Research in Social Sciences, without whom this conference really wouldn't have taken place at all online, let alone physically. So thank you very much to them. Thanks to the DEW committee, and thank you to Dublin Chamber for their kind sponsorship of the conference and keeping us going. So without any further ado, hopefully the pandemic will have somewhat subsided, if not faded away entirely by this time next year, and we'll, instead of being at 5:30 sitting around a screen with our eyes attached to a screen of Zoom, we'll be in somewhere a bit more conducive to continue discussion and debate. So with that, thanks very much everyone again for attending. It's really been super and real learning experience, and we'll hopefully see you at some stage in the next while.